Hello everyone, happy Friday to you. It is Colby, the DJI Crab, coming to you with the video that I do every Friday or the final trading day of every week, where I'm going to take a look at each of the four tiers. These are the 60 high-quality dividend growth stocks that this channel focuses on, and we're going to take a look at where the value lies in each of those four tiers, which are divided out based on the age of the investor. I've got a lot of new subscribers this week, and I've got Ari Gutman to thank for that. Did an interview with him earlier in the week, and if you are here for the first time because you saw me on Ari's show, let me know down there in the comments. Or hey, even if you're one of my OGs, love to hear you leave a comment down below. Let me know what it is that you were buying this week. Now, I'm not a professional financial advisor, so don't take what I'm going to show you in this video as direct financial advice. What I'm doing on this video is sharing with you my strategy, how I go about purchasing my dividend growth stocks to create passive income for myself. And I will also show you exactly what I bought this week following my own strategy and how that brand new portfolio I just started on Weevil is taking shape. So what exactly is my strategy? Well, I'm glad you asked. It's very simple. What it is a minimum of 50% of my money goes into age-appropriate ETFs. So I have immediate diversification no matter what single stock that I might be buying. For single stocks, I want them yielding 30% or more above their 4-year average yield, with the exception of my top 10 favorite stocks. If any of those are yielding 20% or more above the 4-year average, I will go ahead and pull the trigger on those because they are just that good. I'm going to remain in my tier unless there is a stock in a different tier that is yielding 50% above the 4-year average yield. At that point, it is just time to, reach into the other tier and buy value where it is existing. And then finally, if there doesn't happen to be a buyable stock within my tier, what I'm going to do is just add more to ETFs. I'm not going to invest less. I want to continue to build that passive income stream one way or the other. All right, you guys, so let's jump into it. So here we go. Tier 1 for the 18 to 30-year-old investors. We've got two stocks clearly in the buy zone. We're focusing on this valuation tab where I am comparing the 4-year average yield to the current day yield and then garnering my percentage off. And if it is 30% or more, it shows up in green. 20 to 29%, it's going to be in yellow, which is kind of a pseudo buy zone. And then anything in red means that it's just not in my buy zone. Am I selling these stocks? No, I am not. I'm just leaving my dividend reinvestment turned on these to continue to gradually grow out the position. But I'm going to wait to add new money until they get more into this zone. Nike and Nordson are the two stocks in the buy zone. Once again, here for Tier 1, the Nike 4-year average yield did tick up another basis point. We got it up to 1.1% on the 4-year yield. And so long as it stays down here in the 70s, this 4-year average yield is going to gradually creep up. I do update the 4-year average yield every single Friday before I shoot this video. So we have the most up-to-date information on what this 4-year average yield is. I get these numbers from Seeking Alpha. So with a couple of really nice buys here for Tier 1, it's not too difficult of a decision for me. I love both of these stocks. They both look like great adds to me. Tier 1, by the way, we're generally trying to get stocks that are yielding in the lower range. We're talking about like 1.5% yields, but we're looking for a cumulative dividend growth rate year over year of 12% or better. We're talking super compounders with this group to create a real dividend snowball. Tier 2, this is the tier I'm personally in, at least for another year and a few more days. 31 to 41-year-old investors. Looking for starting yield in the 2 to 3% range with a high single-digit annual dividend growth rate. The only one in the group right now in the buy zone is Hershey. However, Target is just right there, 29.96% undervalued. I think this is probably close enough. If you wanted to add some Target at this price at around $151, I think that's a nice value add for you as well. Both of these yielding right at about 3% when you're typically going to get them at 2% or maybe 2.25% in the case of Target. American States Water and Starbucks are okay values right now. Starbucks did a little bit of a dividend increase this week. Look out for my video on Friday or tomorrow going over that in a little bit more detail, but it still wasn't quite enough to get Starbucks back into the buy zone. Everything else here, just looking like we're going to be being patient and sitting and holding all of this stuff. But Hershey has hit that above 50% undervalued mark. So you know what that means. It means any of the other tiers, in my estimation, can feel free to add Hershey here in the low 180s. What a fantastic buy this is. I'm so excited about this one, you guys. Tier 3, age 42 to 53-year-old investors, where we're looking for 3 to 4% starting yields, or an annual growth rate, 5 to maybe 7%, 8%, somewhere in there. We've got a new addition here this week. Genuine Parts Company, stock ticker GPC, crashed and burned. Womp womp. Had a bad quarter of earnings, and it really spooked a lot of people. It dropped 20% in a single day. Very reminiscent of what Nike did a few months ago, and that put GPC from about 10% undervalued to now 36% undervalued. GPC now squarely in the buy zone if you are in this particular age range. And I did want to just take a quick peek here at Genuine Parts Company here on Seeking Alpha. We're going to go to the dividends tab and take a look at the dividend growth just so you can see the history of what this stock typically does. So you can see, we're going to look here at the annual dividend payout growth. Very, very consistent. 6%, 9, couple of 3s, 5, 6, 2, 6, 6, 6, 8, 10, 9, 2, 2, 6, 8, 4, some 1s, some 3s. But you can see here, this one typically just tends to steadily grow. Some years are better than others, and maybe this upcoming year we have a slower dividend growth rate. I don't know for sure. Like I said, it was one bad quarter. Not the first time this company's had a bad quarter over the last few decades. Genuine Parts Company has 67 years of growing that dividend. You guys, this is a dividend king. One of the 10 longest dividend growth streaks among all stocks on the stock market. I love this one, and I'm very happy it's in the buy zone. Congratulations if you are in Tier 3 and you're adding to GPC. Let me know if you did so this week. Tier 4, age 54 and up, we are looking for at least 5% starting yield, if not better. We don't want to throw dividend growth rate out the window. I'd still like that to grow by anywhere from 2 to 4% year over year to keep up with normal inflation. Once you're at the point where you're not reinvesting your dividends, Verizon has hopped up on the top of the list here, about 11% undervalued. Not an awful purchase here, but I don't think that it's worth reaching on an individual single stock, especially in this age range. You don't have time to roll the dice and take risks on individual single stocks unless you're getting a great deal at this point in time. So probably going to be focusing more on the high dividend income ETFs. Once again, while this group of 10 stocks remains pretty overvalued from what I can tell. Quick swing by the top 10 tab. These stocks are all within somewhere in tier 1, 2, or 3. Not a new group of stocks. I just have a separate tab for my top 10. Take a quick look, pause if you need to. These are the 10 that I would keep in my portfolio. If I sold everything else, I'd hold on to these 10. If any of them get to 20%, this is that group. 20% undervalued, I'm going to buy them no matter what tier I'm in. Pepsi's flirting with that, 15% undervalued, but still not quite there yet. I need Pepsi to drop down probably into the mid-160s before I'm going to add on to that. And now let's talk strategy. So, for the strategy allocation, we got a lot of stuff to go over here, man. So, tier 1, I said at the beginning, 50% of my money goes into ETFs for automatic diversification. If I'm in tier 1, this is going to be how I break it down. You could, sub in different similar ETFs, but what I want to do is put about 25% into the S&P 500, 15% into a small cap value, 5% into a dividend growth ETF, and 5% into international. And then for tier 2, same 4 different order. Dividend growth 25%, S&P 500 15, small cap value 5, international 5. Tier 3, when I hit that point, I'm probably going to spread my money over these 3 ETFs. I like them all. VYM, SCHD, DHS. Some overlap with all 3 of them, but very different strategies. Really like all 3 of them. I'd probably go 15% each on these, but hey, if you're in this group and you like one above the others, you could just do 45% into one. I think that'd be just fine. continuing with 5% into international. And then tier 4, my stock-focused ETF would be SPYD, the 80 highest yielding stocks, and the S&P 500. I'm going to put 15% there. Well, then doing 5% into high-yield bonds, 5% into preferred shares, 5% into MLPs, 5% each into Devo, JEPI, and SPYI, my 3 favorite covered call option ETFs, and then, of course, 5% international. For the single stock allocation, tier 1, so this week, if I was down here in tier 1, I'd still be doing 30% of my money into Hershey. 10% would go into Nordson, and then because Hershey hit that 50% undervalued, I'm going to reach up through 10% into Hershey. If you're a tier 1 investor and you want to get a 3% starting yield on a stock instead of those 1.25-ish ones, go ahead and grab some Hershey. If you ask me, I think that's a great buy right now, no matter the age. Tier 2, I'm putting 45% into Hershey. That was the only one that was in that buy zone. I could have done maybe 5% into Target this week, but I just decided to really just go into Hershey, keep building that up. I did reach down and put 5% into Nike because I'm in tier 2. I allocated $100 this week towards new investments in my brand new Webull account. So I'm going to show you guys that here in a minute. But we're going to wrap things up with tier 3 and 4. So tier 3 and 4, I'm going to do 15% into Archer Daniels Midland, the most undervalued stock in that tier. Hormel Foods and GPC, they're going to get 10% each. I'm going to reach down, put 10% into Hershey, and reach down twice and do 5% into Nike here also. And then finally for tier 4, we're going to continue that ETF double down. Instead of 15, 5, 5, 5, 5, 5, I'm doing 30%, 10, 10, 10, 10, 10, 10. Not doing 10 into international. I'm going to keep that consistent at 5%. I'm going to reach down and grab Hershey. Even at this age, it's such a great deal, you guys. 5% into Hershey. It's just a 3% starting yield, which isn't as high as I'd like to get in tier 4, but you still want to every now and again add something that's going to give you some nice growth. And I don't think trickling in a little bit of money into Hershey at this time is the worst idea in the world. So DJI Crab Portfolio. I started this one last week in Webull. I'm going to put it minimum $100 a week into this portfolio so you can see how the DJI Crab allocation strategy is going to work over time. Now, I'm going to ask you guys for some help here. I did find something out about Webull this week that I don't like. You can't get dividend reinvestment to happen in Webull unless you own at least a full share of a stock. Now, not a huge deal for some of the lower dollar ones, but like for VOO, it's going to take me a little while to get that up above $532. And you know, my dividends aren't going to reinvest up to that point. Don't love that. Don't love the desktop interface either, you guys. So if you know of another app where you can buy fractional shares and have the dividend reinvestment go in, even if it's just some pennies, then please let me know what that is down in the comments below. I already utilized both Robinhood and SoFi. Those both allow for that. If there's some other ones out there that you're aware of for sure that will do that, leave it in the comments below because I might actually switch this out since I'm very early on in the process here. If not the end of the world. I can deal with that and sort of make it work. But I'd really like something that would allow me to reinvest dividends, even if I'm just sitting here on some partial shares. So, hey, this is what I did. 45 of those $100 went into Hershey, 25 VIG, 15 VOO, 5 each into Nike, VBR, and VYMI. I added $2.39 of annual forward dividend income, bringing the total up to $4.74. Don't have a full share of any of this stuff in here just yet, you guys. But again, I wanted to show you what it looks like to just start from the ground up if you're in tier 2 and really put my money where my mouth is. This is how I'm tracking this stuff, you guys, looking at just current price, dividends per share. That's given me the current yield, keeping track of how much money I've invested into each position, how many shares I have in those. The overall value, I'm not super worried about this right now. What I'm really worried about is how much annual income those positions are generating, and that's where I'm at. So again, you guys, that is another video for the week. Let me know what you were buying. Let me know about a brokerage account that might be better for this strategy than Webull if you know of one. And send me any questions to dgicrab@yahoo.com. Have a great weekend, everybody. get your plan set for next week, and I'll see you next time.